reforms. Services to labor. Our government will facilitate the provision of a wide array of services to labor, including those for employment and skilling. A comprehensive integration of e-Shram portal with other portals will facilitate such one-stop solution. Open architecture databases for the rapidly changing labor market, skill requirements, and available job roles, and a mechanism to connect job aspirants with potential employers and skill providers will be covered in these services. Shram Suvidha and Samadhan portal. Shram Suvidha and Samadhan portal will be revamped to enhance ease of compliance for industry and trade. Capital and entrepreneurship related reforms, financial sector vision and strategy. For meeting financing needs of the economy, our government will bring out a financial sector vision and strategy document to prepare the sector in terms of size, capacity, and skills. This will set the agenda for the next 5 years and guide the work of the government, regulators, financial institutions, and market participants. Taxonomy for climate finance. We will develop taxonomy for climate finance for enhancing the availability of capital for climate adaptation and mitigation. This will support achievement of the country's climate commitments and green transition. Variable capital company structure. We will seek the required legislative approval for providing an efficient and flexible mode for financing leasing of aircrafts and ships and pooled funds of private equity through a variable company structure. Foreign direct investments and overseas investment. The rules and regulations for foreign direct investment and overseas investments will be simplified to 1. Facilitate foreign direct investments, 2. Nudge prioritization, and 3. Promote opportunities for using Indian rupee as a currency for overseas investment. NPS Vatsalya. NPS Vatsalya, a plan for contribution by parents and guardians for minors, will be started. On attaining the age of majority, the plan can be converted seamlessly into a normal NPS account. Use of technology. We have successfully used technology for improving productivity and bridging inequality in our economy during the past 10 years. Public investment in digital infrastructure and innovations by the private sector have helped in improving access of all citizens, particularly the common people, to market resources, education, health, and services. We will step up adoption of technology towards digitalization of the economy. Ease of doing business. For enhancing ease of doing business, we are already working on the Jan Vishwas Bill 2.0. Further, states will be incentivized for implementation of the business reforms, action plans, and digitalization. Data and statistics. For improving data governance, collection, processing and management of data and statistics, different sectoral databases, including those established under the Digital India Mission, will be utilized with active use of technology tools. New pension scheme. The committee to review the NPS has made considerable progress in its work. I'm happy that the staff side of the National Council of the Joint Consultative Machinery for Central Government Employees has taken a constructive approach. A solution will be evolved which addresses the relevant issues while maintaining fiscal prudence to protect the common citizens. Budget estimates for 24-25. For the year 24-25, total receipts other than borrowings and the total expenditure are estimated at 32.07 lakh crore rupees and 48.21 lakh crore rupees respectively. The net tax receipts are estimated at 25.83 lakh crore rupees. The fiscal deficit is estimated at 4.9% of the GDP. The gross and the net market borrowings through dated securities during 24-25 are estimated at 14.01 lakh crore rupees and 11.63 lakh crore rupees respectively. Both will be less than that in 23-24. The fiscal consolidation path announced by me in 2021 has served our economy very well, and we aim to reach the deficit below 4.5% next year. The government is committed to staying the course. From 2026-27 onwards, our endeavor will be to keep the fiscal deficit each year such that the central government's debt will be on a declining path as percentage of GDP. I will now move to part B. Indirect taxes. Sir, I start with GST. It has decreased tax incidence on the common man, reduced compliance burden and logistics cost for trade and industry, and enhanced revenues of the central and the state governments. It is a success of vast proportions. To multiply the benefits of GST, we will strive to further simplify and rationalize the tax structure and endeavor to expand it to the remaining sectors. My proposals for customs duties intend to support domestic manufacturing, deepen local value addition, promote export competitiveness, and simplify taxation while keeping the interest of the general public and consumers surmount. In Budget 22-23, we reduced the number of customs duty rates. I propose to undertake a comprehensive review of the rate structure over the next 6 months to rationalize and simplify it for ease of trade, removal of duty inversion, and reduction of disputes. I shall now take up sector-specific customs duty proposals. Medicine and medical equipments. To provide relief to cancer patients, I propose to fully exempt 3 more medicines from customs duties. I also propose changes in the BCD on X-ray tubes and flat panel detectors for use in medical X-ray machines under the phased manufacturing program so as to synchronize them with the domestic capacity addition. Mobile phone and related parts. With a 3-fold increase in domestic production and almost a 100-fold jump in exports of mobile phones over the last 6 years, the Indian mobile industry has matured. In the interest of consumers, I now propose to reduce the BCD on mobile phone, mobile PCBA, and mobile charger to 15%. Critical minerals. Minerals such as lithium, copper, cobalt, and rare earth elements are critical for sectors like nuclear energy, renewable energy, space, defense, telecommunications, and high-tech electronics. I propose to fully exempt customs duties on 25 critical minerals and reduce BCD on 2 of them. This will provide a major fillip to the processing and refining of such minerals and help secure their availability for these strategic and important sectors. Solar energy. Energy transition is critical in the fight against climate change. To support energy transition, I propose to expand the list of exempted capital goods for use in the manufacture of solar cells and panels in the country. Further, in view of sufficient domestic manufacturing capacity of solar gas, glass, and tinned copper interconnect, I propose not to extend the exemption of custom duties provided to them. Marine products. India's seafood exports in the last financial year touched an all-time high of more than 60,000 crores of rupees. Frozen shrimp accounted for about 2/3 of these exports. To enhance their competitiveness, I propose to reduce BCD on certain broodstock, polychaete worms, shrimp, and fish feed to 5%. I also propose to exempt customs duty on various inputs for manufacture of shrimp and fish feed. Leather and textile. Similarly, to enhance the competitiveness of exports in the leather and textile sectors, I propose to reduce BCD on real down-filling material from duck or goose. I am also making additions to the list of exempted goods for manufacture of leather and textile garments, footwear, and other leather articles for export. To rectify inversion in duty, I propose to reduce BCD subject to conditions on methylene diphenyl diisocyanate MDI for manufacture of spandex yarn from 7.5 to 5%. Furthermore, the export duty structure on raw hides, skin, and leather is proposed to be simplified and rationalized. Precious metals. To enhance domestic value addition in gold and precious metal jewelry in the country, I propose to reduce customs duties on gold and silver to 6% and that of platinum to 6.4%. Other metals, steel and copper are important raw materials. To reduce their cost of production, I propose to remove the BCD on ferronickel and blister copper. I am also continuing with nil BCD on ferrous scrap and nickel cathode and concessional BCD of 2.5% on copper scrap. Electronics. To increase value addition in the domestic electronics industry, I propose to remove the BCD subject to conditions on oxygen-free copper for manufacture of resistors. I also propose to exempt certain parts for manufacture of connectors. Chemicals and petrochemicals. To support existing and new capacities in the pipeline, I propose to increase the BCD on ammonium nitrate from 7.5% to 10%. Plastics. PVC flex banners are non-biodegradable and hazardous for environment and health. To curb their imports, I propose to raise the BCD on them from 10 to 25%. Telecommunication equipment. To incentivize domestic manufacturing, I propose to increase the BCD from 10 to 15% on PCBA of specified telecom equipment. Trade facilitation. To promote domestic aviation and boat and ship MRO, I propose to extend the period for export of goods imported for repairs from 6 months to 1 year. I'll read that again. To promote domestic aviation and boat and ship maintenance, repair, and operations, I propose to extend the period for export of goods imported for repairs from 6 months to 1 year. In the same vein, I propose to extend the time limit for re-import of goods for repairs under warranty from 3 to 5 years. I now move to direct taxes. We will continue our efforts to simplify taxes, improve taxpayer services, provide tax certainty, and reduce litigation while enhancing revenues for funding the development and welfare schemes of the government. It has been our endeavor to simplify taxation. We have taken a number of measures in the last few years, including introduction of simplified tax regimes without exemptions and deductions for corporate tax and for personal income tax. This has been appreciated by taxpayers. 58% of corporate tax came from the simplified tax regime in the financial year 22-23. Similarly, as per data available till now, for the last fiscal, more than 2/3 have availed the new personal income tax regime. Comprehensive review of the Income Tax Act. I am now announcing a comprehensive review of the Income Tax Act 1961. The purpose is to make the act concise, lucid, easy to read and understand. This will reduce disputes and litigation, thereby providing tax certainty to the taxpayers. I will also bring down the demand embroiled in litigation. It is proposed to be completed in 6 months. A beginning is being made in the finance bill by simplifying the tax regime for charities, TDS rate structures, provisions of reassessment and such provisions, and capital gains taxation. Simplification for charities and TDS. Two tax exemption regimes. The two tax exemption regimes for charities are proposed to be merged into one. The 5% TDS rate on many payments is being merged into the 2% TDS rate, and the 20% TDS rate on repurchase of units by mutual funds or UTI is being withdrawn. TDS rate on e-commerce operators is proposed to be reduced from 1 to 0.1%. Moreover, credit of TCS is proposed to be given in the TDS to be deducted on salary. Further, I propose to decriminalize delay for payment of TDS up to the due date of filing statement for the same. I also plan to provide a standard operating procedure for TDS defaults and simplify and rationalize the compounding guidelines for such defaults. Simplification of reassessment. I propose to thoroughly simplify the provisions for reopening and reassessment. An assessment hereinafter can be reopened beyond 3 years from the end of the assessment year only if the escaped income is 50 lakh rupees or more, up to a maximum period of 5 years from the end of the assessment year. Even in such cases, a time limit of 6 years before the year of the search, as against the existing time limit of 10 years, is being proposed. This will reduce tax uncertainty and disputes. Simplification and rationalization of capital gains. Capital gains taxation is also proposed to be hugely simplified. Short-term gains on certain financial assets shall henceforth attract a tax rate of 20%, while that on all other financial assets and all non-financial assets shall continue to attract the applicable tax rate. Long-term gains on all financial and non-financial assets, on the other hand, will attract a tax rate of 12.5%. For the benefit of the lower and the middle income classes, I propose to increase the limit of exemption of capital gains on certain financial assets to 1.25 lakh rupees per year. Listed financial assets held for more than a year will be classified as long-term, while unlisted financial assets and all non-financial assets will have to be held for at least 2 years to be classified as long-term. Unlisted bonds and debentures, debt mutual funds, and market-linked debentures, irrespective of holding period, however, will attract tax on capital gains at applicable rates. Taxpayer services. All the major taxpayer services under GST and most services under customs and income tax have been digitalized. All remaining services of customs and income tax, including rectification and order giving effect to appellate orders, shall be digitalized and made paperless over the next 2 years. Litigation and appeals. While our concerted efforts to reduce pendency of appeals at various appellate fora are beginning to show good results, it will continue to engage our highest attention. To dispose of the backlog of first appeals, I plan to deploy more officers to hear and decide such appeals, especially those with large tax effect. For resolution of certain income tax disputes pending in appeal, I am also proposing Vivad Se Vishwas Scheme 2024. Further, I propose to increase monetary limits for filing appeals related to direct taxes, excise, and service tax in the tax tribunals, high courts, and Supreme Court to 60 lakh rupees, 2 crore rupees, and 5 crore respectively, with a view to reduce litigation and provide certainty in international taxation. We will expand the scope of safe harbor rules and make them more attractive. We will also streamline the transfer pricing assessment procedure. Employment and investment. I have a few proposals to promote investment and foster employment. First of all, to bolster the Indian startup ecosystem, boost the entrepreneurial spirit, and to support innovation, I propose to abolish the so-called angel tax for all classes of investors. Second, there is tremendous potential for cruise tourism in India. To give a fillip to this employment-generating industry, I am proposing a simpler tax regime for foreign shipping companies operating domestic cruises in the country. Third, India is a world leader in the diamond cutting and polishing industry, which employs a large number of skilled workers. To further promote the development of this sector, we would provide for safe harbor rates for foreign mining companies selling raw diamonds in the country. Fourth, to attract foreign capital for our development needs, I propose to reduce the corporate tax rate on foreign companies from 40 to 35%. Deepening the tax base. I have a couple of proposals for deepening the tax base. First, security transaction tax on futures and options of securities is proposed to be increased to 0.02% and 0.1% respectively. Second, for reasons of equity, I propose to tax income received on buyback of shares in the hands of recipients. Other proposals. To improve social security benefits, deduction of expenditure by employers towards NPS is proposed to be increased from 10 to 14% of the employee's salary. Similarly, deduction of this expenditure up to 14% of salary from the income of employees in private sector, public sector banks, and undertakings opting for the new tax regime is proposed to be provided. Indian professionals working in multinationals get ESOPs and invest in social security schemes and other movable assets abroad. Non-reporting of such small foreign assets has penal consequences under the Black Money Act. Such non-reporting of movable assets up to 20 lakh rupees is proposed to be depenalized. Other major proposals in the finance bill relate to withdrawal of equalization levy of 2%, expansion of tax benefits to certain funds and entities in IFSCs, and immunity from penalty and prosecution to Benamidar on full and true disclosure so as to improve conviction under the Benami Transaction Prohibition Act 1988. Personal income tax. Coming to personal income tax rates, I have two announcements to make for those opting for the new tax regime. First, the standard deduction for salaried employees is proposed to be increased from 50,000 to 75,000 rupees. Similarly, deduction on family pension for pensioners is proposed to be enhanced from 15,000 to 25,000 rupees. This will provide relief to about 4 crore salaried individuals and pensioners. Second, in the new tax regime, the tax rate structure is proposed to be revised as follows. 0 to 3 lakh rupees, nil. 3 to 7 lakh rupees, 5%. 7 to 10 lakh rupees, 10%. 10 to 12 lakh rupees, 15%. 12 to 15 lakh rupees, 20%. And above 15 lakh rupees, 30%. As a result of these changes, a salaried employee in the new tax regime stands to save up to 17,500 rupees in income tax. Apart from these, I'm also making some other changes as given in the annexure. As a result of these proposals, revenue of about 37,000 crore, that is 29,000 crore in direct taxes and 8,000 crore in indirect taxes will be foregone, while revenue of about 30,000 crore rupees will be additionally mobilized. Thus, the total revenue foregone is about 7,000 crores annually. Mr. Speaker, sir, with this, I commend the budget to this august House. Jai Hind.
Item number 2. Item number 2.
Okay, no relief if you're an investor. You pay high capital gains, and you can see the mid-cap index nosediving 2% and the Nifty nosediving 1%. But relief for all of us, 17,500 rupees by way of taxes. I think the Finance Minister is speaking again.
Budget Management, FRBM Act 2003, medium-term fiscal policy cum fiscal policy strategy statement, and macroeconomic framework statement.
Item number 3.
Sir, with your permission, I rise to move for leave to introduce the Finance number 2 Bill 2024.
प्रश्न ये कि विधेयक को पूरा स्थापित करने की अनुमति प्रदान की जाए। जो सदस्य इसके पक्ष में हाँ कहें।
Okay, well, that is the Finance Minister. The budget is done. And I think the big news, of course, is taxation on equities capital gains, taxes being tinkered with. The long-term tax has moved up from 10% to 12.5%. The short-term rate has gone up from 15% to 20%. And I think that is essentially, from a market perspective, the big headline. I mean, you know, before the Finance Minister reached that tax section, the market was holding with just about a 50-odd point cut on the Nifty. That's gone straight to for the Nifty to be down about 300 points. I mean, lots of changes as far as taxes are concerned. You know, for the startup world, there is the angel tax, which has now been abolished. And there are many other changes which have been done. But I think the one sort of news point from a taxation perspective, which I think straight off the bat overshadows pretty much everything else right now, is the fact that equities capital gains taxation has been increased both on the long term and on the short term as well. And I think there is, of course, on the futures and options income, futures and options side, STT, which has also actually been increased. So, after the economic survey yesterday, there was anticipation on the F&O side, and some of the anticipation with regards to capital gains tax on listed equities that had faded away a little bit, but has come back in a big way. I would say this is, a very, very large tax budget more than anything else, with lots of changes on, direct taxes, lots of changes on the custom side, indirect taxation, and much more as well. 350 points down on the Nifty now, so that's the kind of cut that we're seeing. At this point, the market, of course, reacting in a pretty large way. This is a knee-jerk reaction, but I think what was the market's fear has come through. 24,190 is where we're at on the Nifty. Shireen, you've been talking. Sorry.
To be fair, there has been a little more money put in the hands of taxpayers as well.
Yeah.
But I think the market at the moment is only reacting to the fact that market gains are going to be taxed and taxed substantially higher.
Yeah.
15 to 30% to 20% is 30% more amount in terms of
Though that exemption of 1 lakh that we had on long-term capital gains, that's been increased slightly to now
1,25,000.
but
that's
not
marginal.
But
it is a very big takeaway from the markets, and the markets are reacting. To be fair, they were also sitting long, and therefore some bit of a correction. Buy on news, buy on rumor and sell on news was always there. But this is something very big for the market. Shireen, anything more with you?
Yeah, Lata, outside of what we've already discussed, which is the changes on the capital gain side as well as F&O and so on and so forth, I think the fine print will have to be looked at, and we have our tax panel here with us. I think the larger message is the message that we've been pointing out to here on CNBC TV 18. I said very clearly that there is going to be no departure as far as the fiscal math is concerned. What was industry saying? That the government capex number has to go up substantially. What has the finance minister delivered? 11.11 lakh crore rupees, exactly the same number that was there in the interim budget. Similar story playing out even as far as the rural allocation is concerned. So there has been no deviation, no departure from the fiscal arithmetic as far as the interim budget was concerned. Good news on the fiscal deficit, again, something that we had reported, 4.9% is the government estimate now as far as fiscal deficit is concerned. So making it clear they are sticking to the fiscal consolidation roadmap. But, there is a lot in this budget, Lata. A lot of it is work in progress. The energy transition framework, the employment schemes that the government has put forward. Many of those 9 priorities continue to be work in progress, and of course allocations will have to be looked at in the fine print and so on and so forth. But let's bring the tax experts in on what they make. This was being speculated whether this is going to be the budget that finally moves as far as capital gain simplification is concerned. Dinesh Kanabar, Ashok Vadva, to you first, your reactions on what we've heard from the finance minister. Ashok, to you first.
Obviously, the increase in capital gains tax on listed securities is a bit of a disappointment. We were all hoping that they will keep it intact and retain market buoyancy. But I guess, as the economic survey had mentioned, government wanted to make a move. The distinction is that they're trying to save for the smaller person. In other words, the lower middle class, they've increased the exemption from 1 to 1.25 lakhs. They've increased they've reduced the tax rates. So in a sense, they have provided some comfort there. But obviously, to the market participants, it's 10 going to 12.5, 15 going to 20 on listed stocks. Only partial good news is that they have therefore brought on the unlisted securities, they've brought the capital gains tax down. So where we were taxing long-term at 20%, that will come down to 12.5%. And where we were taxing short-term, 25 or 39, depending upon whether it was a corporate or an individual, they brought it down to 20%. What we don't know is what they have done with real estate, because that didn't come out very clearly in the messaging. So that's unfortunate, but as I said, par for the course now.
Okay, and what about you,
Yes, and
Dinesh?
we will have to look at the fine print on that. Yeah, Lata, go ahead.
No, I was just going to ask Mr. Kanabar, what were the big takeaways on tax?
Quite a few things. Angel tax going away will mean that huge amount of money which was coming in, and we are seeing some horror stories. Although There was a lot of liberalization. The recent part, but still there were horror stories. Again, buyback tax, and we discussed this just before the budget was presented, that be careful what you wish for. So it's not being treated as capital gains. It's going to be tax in the hands of the recipient, which would mean that it could actually, in the hands of larger taxpayers, mean a larger share of tax being paid, because it will be taxed at a full rate. So that's what's going to mean. So it's for lower income people, it's going to mean good. For those who are at a higher tax bracket, it's going to mean higher taxation.
The arbitrage between dividends and buybacks in that sense also goes away.
Goes away. Absolutely.
Well,
Absolutely.
Except Dinesh, are they going to tax buyback on long-term holding as capital gains, or the tax? Because if they are going to tax it in the hands of the individual and it is then taxed as capital gains tax, then the 20 comes down to 12.5. Because today the company is paying a tax at 20%.
She said that. You have to look at the fine print.
I know, but if it's going to be taxed in the hands of the individual, it has to be taxed in the individual as the character.
Yeah.
And if the character is long-term, it doesn't matter whether you buy it or the company buys it. If the character is long-term, then it will be 12.5%. So then there's a gain.
Okay.
The company was paying 20. The individual would be paying 12.
Ashok, as Lata says, we have to see the fine print.
Yes.
You're right, actually. It's not long-term or short-term. It's the characterization. So if the characterization is capital gain, then obviously whatever is the capital gains treatment will apply. If it is treated as normal income, then we have a challenge.
Okay.
So we'll have to examine.
The budget papers are still not loaded.
Yeah.
So we will wait for more clarity. And you guys, I guess, will be on your phones till you get that clarity. But let's get to the market expert. Madhu Kela of MK Ventures joins us now. Madhu, okay, we also have Sunil Singhania of Abacus Asset Management, more experts joining us shortly. Madhu, first thoughts, the market's worst fears realized with short-term capital gains going up to 20%. Yes, Madhu.
Lata, I can't hear you properly.
Okay, it's just that STCG gone up to 20%.
Yeah, I think this is completely not in expected lines. I don't think any market participant in that sense was expecting a change in the short-term capital gains as well as in the long-term capital gains regime. And also the STT is being actually increased. So, and the buyback taxation, if it is moved from company to the individual and there is no charge to the company, then it will be incrementally positive. But by and large, to me, in a lighter sense, looks like the market wants the government markets to cool off. The government wants markets to cool off. While the fiscal math was all adding, this was not the basic expectation of the taxation increase. And already, Rata, markets have run off very hard in the last few months. So some kind of a correction because of this is not overruled, and that is what the markets are showing off.
Well, the markets have recovered coming off those intraday lows. But let me bring Sunil in. Sunil, Madhu is saying the market wasn't expecting this, but the speculation was rife, especially over the last few weeks, that something has got to give as far as the capital gains regime is concerned. It has now been put forward in the budget, and of course, fine print is awaited. Sunil, your first reaction to what we've seen the finance minister deliver?
I think the market reacts based on expectations and what actually comes out. So I would tend to agree that there was hardly anyone who was expecting any change in the capital gain regime, at least in this budget, because we are only 6 months away from the next budget, right? So I think to that extent, there has been a disappointment. And the other thing is uncertainty on this buyback tax, because, the intention of the finance minister maybe was that dividend tax and buyback tax, there was a difference in tax treatment, and buybacks were getting maybe a slightly more benefit in terms of lower taxes. So we have to see the fine print, but obviously when something is not expected, the market definitely reacts. And anyway, I think over the last 10-15 days, market was showing signs of cooling off, at least the broader market. So while the Nifty was not showing signs, the broader markets was clearly showing signs of overheating. So it's a combination of two factors, I would say.
That the fiscal deficit has come down arithmetically to 4.9. So at a macro level, that is a positive, but that doesn't mean they're going to borrow less. The borrowing was originally 14.1. That's just come down to 14.01. So they're going to borrow the same amount of money, but yes, for the arithmetic, it's 4.9. Go ahead, Prashant.
Absolutely. I mean, look at the, don't lose sight of the index, the market as well. We had fallen about 400 points on the Nifty, and, it's a 250 odd point recovery since. So, is going to be as powerful, recovery as we've seen after the election shock? Some have, of course, said no. But this is too early. I mean, this is the first knee-jerk kind of reaction which is coming in, and I think it'll take time for it to kind of sort of seep through and markets to find the appropriate kind of level. Prashant Khemka is also with us. Prashant, I'm going to come to you. Madhu, but what is your sense? I mean, as I said, this is immediate kind of market reaction, but is this going to do slightly more lasting damage? Or, as you said, government wants markets to cool off. Will it cool off?
I do not think it will be a lasting damage or anything of that kind, Prashant. It doesn't change the medium and long-term outlook of Indian economy or the stock market per se. I think the government, in other sense, has done quite a lot for agriculture, for job creation. There is a lot in the finer print. They have retained the capital expenditure as budgeted in the interim budget. See why there is a knee-jerk reaction, because this, at least I was not expecting, because see, when we went into the budget, in 30 years of my career, I have not seen a better financial position of any government or any budget which being presented, when because of the RBI dividend and because of the higher taxation, the government fiscal situation was really in a very sound path. So this was not expected. There is some knee-jerk reaction, but I don't think it changes any trajectory, or it will bring in any meaningful correction in the market just because we have slightly higher capital gains taxation.
Okay.
Sunil, you want to sort of come in on that point? I mean, today the reaction is the reaction because it's a surprise, but do you think we'll have a sort of lingering kind of impact, or the market just moves on?
No, so if you go back, Prashant, when long-term capital gains tax was introduced, to 10% from 0%, we did have an impact in the market. But then the market started taking it on its stride, because ultimately you're paying capital gains on the gains you are making. So I would agree that at least on this point, the market will take it on its strides. But there are a lot of things which we have to understand, whether there will be grandfathering like the ones which we did earlier, or is there a date from which this is going to be applicable, whether it is going to be applicable from day one, or whether, it's going to be applicable after a month. So if that would be the case, then there would be obviously some pressure, because investors would like to book their gains at lower tax rates. So I think let us see the fine print, but I think the markets were clearly overheated, and some cool off for some reason was necessitated. And basically, maybe this is the reason why markets would cool down a little bit. So I would say that it would not sort of collapse per se. Maybe they will spend some time here, but I would not expect either a big correction or a V-shaped recovery.
And any stock preferences, sector preferences, Sunil, after you heard the budget, any stock sector preferences?
I don't think there is anything, which is sort of a surprise as far as positives or negatives in the budget is concerned. I think we were all expecting a focus on infra to continue, focus on housing, obviously focus on giving more to the middle class, which they have done by way of reduced taxes. So I think everything has been online. I don't think, except for some minor tweaks here and there in terms of import duties, it's the same as it was earlier.
Okay. Thanks for that, Sunil. Let's
begin. Prashant Khemka is where he's waiting by.
That's what I was
and he manages a lot of foreign money. Prashant, good to have you with us here. From an attractiveness point of view, purely on a taxation regime basis, how does this capital gains tax increase count? I mean, in your opinion?
Certainly, Prashant, like every budget, it has some puts and takes, and maybe from an investor perspective, this budget, after a few budgets, is a bit more negative, I would say, on the taxation front in particular. There was some expectation that long-term capital gains tax might be increased, but with indexation benefit. So today what we've seen is that there isn't an indexation benefit, and plus it, I think, increases the risk In a way, there was a stability in the capital gains regime for the last several years. Now the long-term gains tax has been raised by only 2.5%, short terms raised to 20, but this increases the risk in investors' mind that it could be a tax regime for next many years. It is possible that this could be inching up higher again at some point in time. So that I would say is negative, but that is the primary negative of the budget. There are several positives as well,
Sure.
most particularly on the review of the tax code, which hopefully would simplify and make it easier to comply with.
Okay. Prashant, hi. Thank you for joining us on the show. So this, of course, is the knee-jerk reaction that we're seeing on the markets right now. And it has come as a negative surprise, and hence the market is factoring in. But, you know, as Sunil was also mentioning a while back, this may not change the medium-term outlook for the market, because at the end of the day, you are paying capital gains tax on gains in the market, which have been aplenty over the last many years. So if this dip continues because of the reaction to these changes, would you suggest a buy on dip strategy is a good approach? I mean, would you buy the dip that we're seeing in the market right now?
So certainly taxes are on gains only. I mean, you don't, on the other hand, you don't recoup anything on your losses. So, you know, net, it is hard to paint it as a positive. But on the knee-jerk reaction or not, yes, I mean, taxes, I don't think ever have had a lasting impact. As Sunil and Madhur pointed out, and we all know the markets have been somewhat of a heady, progression over the last 2 years, up 60%, 2 years up 30% or so. These are not like normal returns from the market. So, regardless of the budget, one could have reasonably expected markets to be more normal going forward, which is deliver high single-digit, low double-digit returns. So this would not, whatever reaction the market has to have to this tax, would be done either today or by tomorrow. Regardless of market reaction, I think the point remains that the expectation was not there of a capital gains hike without indexation benefit in this budget.
Yeah, no, absolutely. You know, I'm going to come to the tax experts as well, but I think Madhu, make a point.
Yeah, Prashant, I just got a message. I hope it is right that this capital gains taxation calculation, as Sunil was saying, is on a prospective basis and it is not applicable to securities held before this budget announcement today. So whatever you buy after today will be applicable on a long-term capital gains and short-term capital gains. So it is some relief. It is not applicable, hopefully, to the shares being held before this date.
Now, that's.
I hope this message is right.
No,
I'll pray for it.
We will.
It is right.
No, I think everyone will prefer it. It's on a prospective basis and not a retrospective basis, and we'll sort of look at the fine print in just a bit. But I think Nilesh Shah is also with us. Nilesh bhai, okay, I think we'll just go to him in a bit. Ashok, the point about prospectiveness. I mean,
historically, it's always been point of sale.
Yeah.
So if you go with the point of sale, it doesn't matter whether you bought it before or after. I would believe that consistency is unlikely to have changed.
Okay.
But let's look at the fine print. I mean, who knows? They may have just brought in a specific. But Dinesh will make an important point on dividend. I had said that it's likely that buyback could be treated as capital gains. That clarification has come. It will be treated as dividend.
So they have actually specifically amended the law to say that any buyback income will be treated as dividends. And therefore, virtually it kills buyback because for higher income.
Okay, and so it's treated at the slab rate.
Absolutely.
And I'm seeing quite a few. I mean, too early to comment on all the fine print, but as I was going through, one of the things, for example, in the pharma industry, we see is that there are litigation on infringement of patents and things like that. Yeah. And then you do a settlement. Now that settlement payments are treated as non-deductible because it is treated as infraction of law. The number of fine prints, I could see quite a few things.
Okay. We'll come to that. At the moment, the market is kind of recovering from the big blow. It was down about 3%, the mid-cap index in particular. Now still down about 1.3%, but I think people are more playing profit booking or profit taking as the case may be. I think we will have to give it the budget that it has tried to ameliorate some of the important long-term work. For instance, trying to encourage corporate apprenticeship of newcomers. You know, the benefits that they're providing if you hire new employees, I think up to 1 crore youth could benefit. So there are these long-term benefits. Macroeconomically, the deficit is down. Maybe in the days to come, that would mean a rating upgrade for India because we are rapidly bringing down our fiscal deficit. You cannot take away from these macro positives in terms of what is done for employment and what is in terms of what is done for macro health of the economy. But at the moment, we are focused on the capital gains, and therefore the market is reacting the way it is reacting. Madhukela, any sector preferences at this point in time after what you heard in the budget?
Yeah, Lata, is life back to normal in my view. I think this is now these days budget do not have a more than 48-hour lifeline, and because the reforms are carried throughout the year, I would continue to focus on bottom-up stock investing opportunities. I think agriculture could be one interesting sector to look at it. One will have to read the fine print, but there will be some beneficiary on the agriculture sector and also on the broader economic front, because they have retained the capital expenditure plan which was being outlaid in the interim budget. So Lata, it will be a story not of any big sector, but bottom-up stock picking going forward.
Yeah, I just want to come in here and bring Nilesh into the conversation as well. And while we're talking about the negative impact of the tax announcements that have come in, there have been many positive announcements that have come in as well. Abolishing the angel tax, which is a big one for the venture capital and the angel tax community for the startup ecosystem. The equalization levy, by the way, has also been done away with it. What was popularly called Google tax, that's been done away with as well. There is a TDS cut even as far as e-commerce platforms are concerned. So there is a lot actually on the tax front, and of course the benefits to taxpayers, to the salaried class, if they move to the new tax regime. The finance minister holding out a number of about 17,500 rupees by way of savings. But Nilesh, on balance, as far as the big numbers are concerned, it's the same. It's pretty much status quo when we talk about CapEx. When we talk about capex, when we talk about the rural spends, etc., food subsidy, that number flashing on our screens, and of course we will go over the fine print of many of those schemes that were announced. By the way, the MSME scheme, and I think the bank stocks reacted to that as well, because this was a proposal, it was a demand made by the MSME sector in terms of credit guarantee and especially not counting them as an NPA when they were SMAs. So there's been plenty that's been announced as far as the SME sector is concerned. But let me go across to Mr. Amitabh Kant as well. He joins us now for the first reaction from the government's end. Mr. Kant, always a pleasure. Many thanks for joining us. The budget is now delivered. There's plenty there on the tax front. Some of the concerns there with respect to long-term capital gains and the changes that have been announced. But on balance, the message is one of continuity. The message is one of macroeconomic stability. Your first reaction, Mr. Kant?
So, Shireen, I think the focus really is on growth with huge emphasis on employment. I think the important thing is to, if, as the economic survey said, if you have to create 8 million jobs a year, these new schemes on employment, that first-time employees to get their 1 month's salary, or the second one, both employer and employees to benefit, and secondly, from their EPFO account, and thirdly, for the employers, again, to benefit. And then a new scheme for skilling, the centrally sponsored scheme for skilling. And to my mind, this internship with about 500 top companies. All these are path-breaking measures to my mind in terms of employment. But the other big thing too is the focus on urban development, creating growth centers next to 100 cities, creating industrial parks next to, the 12 industrial parks. Because if you want to create good quality jobs, it's not through subsidization. That'll come through manufacturing and through urbanization. And that's very important. And the third is, the focus on energy transition, which is very important. And this emphasis on pumped storage, for which, to my mind, there's huge potential, and small modular reactor, because these are cutting-edge technology where India has to leapfrog. And, this doing away with the angel tax for startups is again a path-breaking move. So other than the stock market may look at the tax on the long-term investments, etc., stock market, but from a perspective of growth, from the perspective of employment, from the perspective of research and innovation and urban development, it's quite a remarkable budget.
Yes, we will have to see the fine print of those schemes that were announced specifically for employment. The good news is that they have linked that to the EPFO enrollment for the formal sector. But Mr. Kant, two questions I have specifically for you. Yesterday, the economic survey made it very clear that, look, corporates are sitting on record profitability. Corporate profitability has quadrupled in the last 3 years. And it is now time for the private sector to take up the baton. And if you look at the CapEx number, the ask and the expectation was that the government needs to do better than the interim budget, but that's not the case. It's status quo on CapEx. So the message that the government seems to be sending out is, we've done our part, and now the private sector needs to pick up the pace. But in that transition period, do you envisage some hiccups on growth, Mr. Kant?
So, Shireen, taking it from 1% to 3.4% is a huge amount. And if you look at it, the government in the last 3 to 4 years has really pushed all its resources into CapEx spend. And to my mind, it continues to do that at 3.4%. But it's also time now for the private sector investment to kick in a big way. And to my mind, that was impacted because of the COVID, but it has started kicking in, and it will drive greater impetus with this budget. So I envisage that in the coming years, in a lot of sectors, particularly the PLI-related sectors, you will see a lot of fresh investments coming in. And I don't think we need to worry on that count. The government has really done its best. To stick on to 3.4% capex itself is a very huge thing, and yet to bring down your fiscal deficit to 4.9%. That, to my mind, is a remarkable thing, that you are saying 4.9%, you will bring it down to 4.5%. You're really laying down the glide path for the fiscal deficit in the budget, which in the long run is very critical for the Indian economy.
Mr. Kant, a valid point that you make there. I will address the PLI issue with you in just a second, but let me get Madhu Kela back into the conversation. Madhu, from a consumption point of view and the changes that the government has brought in to try and provide some sweetness to and some relief to the salaried class, what do you believe that that's going to result in as far as the consumption cycle is concerned, if anything at all?
I think it will argue very well for the consumption cycle, Sareen. Any which way we are coming off from a 2-3 year kind of low, wherein because of inflation concern and because of unemployment concern, there has been some kind of a consumption slowdown. And in a way, market is validating. If you see the uptick in a lot of consumption-related companies over the last 1.5, 2 months, a lot of companies have gained ground. So I think this budget as a whole, if there was really no tinkering of this short-term and long-term capital gains, I would think markets would have really celebrated, because there is, as Mr. Kant was saying, there is a lot of positives in the budget, and there are a lot of positives in the fine print, and the unemployment issue is really being addressed as much as I could hear and understand. That there will be a lot of job creation opportunities for the youth going forward, which will argue very well for the broad-based recovery of the economy, and also of the consumption-related sector going forward.
Gentlemen, just for the benefit of all of our viewers, you had asked for that clarification. Sunil had asked for it, or I think Madhu specifically. The STT hike is effective from the 23rd of July. So basically, it's effective from today. The hike, as far as the securities transaction taxes, the STT hike has come in from the 23rd of July. I would imagine that's the case for some of the other tax changes that have been announced as well. So that's the clarification coming in effective the 23rd of July. But Mr. Kant, coming back now to the measures as far as the manufacturing sector is concerned, and I guess you will need to see this holistically in light of what has happened on the customs duty side, in light of what has happened on the announcements on the industrial parks, MSMEs and so on and so forth as well. But the expectation was more PLI schemes would be introduced, especially for labor-intensive sectors. That's not been the case. Your comments on that?
So I think the best thing, to my mind, Shireen, the finance minister has done is not to spread the PLI thin. An important thing is that the PLI is meant to create large champions, big champions, and PLI should be limited to 14 sectors. We must ensure success, as we've done in the case of electronics, in the other 13 sectors. PLI should never be spread thin. That is not a long-term solution. The long-term solution is to make India a very highly competitive nation. It should become very easy, simple. It must become the most cost-competitive nation in the world. That is what the budget aims at. PLI is meant for 5 years if you go big, bigger, bigger, and biggest. But it's not a solution for inefficiencies. The government is trying to address macro inefficiencies in our economy. We must get that right. And therefore, I'm really, really grateful to the finance minister that she's not spread out the PLI thin.
Mr. Kant, coming back to you in just a second, sir, but we do have more clarifications with regards to the capital gains tax. Lata, the fine print, what do we know now?
Yeah, you know, there was an understanding, and I want Madhu Kela to listen in to this. There was an expectation that the long-term capital, the short-term capital gains increase will only apply to shares purchased here on. Dinesh Kanabar clarifies, no, it applies to all shares that you hold, and it will apply from whatever sales you do from today. Mr. Kanabar.
Actually, the entire income for the year will be taxed at 12.5%. So it's income for arising after 1st April 24. Okay. If you have made a long-term capital gain, the rate will be not 10 but 12.5%.
And likewise for short term
as well.
Absolutely.
And on real estate, Mr. Kanabar, can you just...
The period of holding has been reduced from 36 months to 24 months, which again is a very... I think what the finance minister has done is she has taken the suggestion of simplification very seriously. So instead of having multiple holding periods for multiple class of assets, she has put financial asset on one side, other assets on the other side, and put up a common structure
and
for
financial assets. It's 12 months.
Yeah.
All other assets are 24 months.
That's right.
I wonder if there will be some impact on realty
What we
stocks.
don't know is, given that this budget is being presented on July 23rd, whether gains made between April and July. So if I sold something in this financial year between April and July, is that 10% or 12.5%? It will be 12.5%. So in a sense,
it is retrospective. It's opposite of what Madhu is saying.
Versus Madhu saying that this is prospective. It is actually, so STT is prospective.
Maybe, yeah, STT is prospective, but LTC, STCG and LTCG.
Yeah, both short-term capital gains and long-term capital gains is effective April 1, 2024.
In
a sense,
and just to clarify, it is always so. So, for example, even the last interim budget, 2018, the surcharge was increased substantially. That was the budget where it went to 41%. It applied to all income from 1st April.
April 1st.
So, to that extent, it does become retrospective, and that can't be helped.
Madhu, you want to come in quickly, respond? Okay, I think we don't have Madhu. Nilesh is with us of Kotak Mahindra Asset Management. Nilesh, good to have you back. You know, your first thoughts on what's been done on the capital gains tax side?
So essentially, you know, if you look at capital gains, they were removed and STT was levied. Then in 2018, capital gains came back. And now the rates have been increased. The amounts are not going to be more than 20,000-30,000 crore by way of collection. And if we include the revised increase limit from 1 lakh rupee to 1,25,000 rupee, then even that collection will come down. Now, clearly for such a small amount, was there a need to increase this taxes? I think this could have been achieved by creating level playing field between foreign investors and Indian investors. When Indian investors trade in derivatives, it's business income and it gets taxed at applicable slab rates. When foreign investors trade in derivatives, it is considered as capital gain. And there are so many high-frequency traders trading in our market, making tons of money and paying no taxes. It would have been better to tax them and create a level playing for investors and get the same amount of money. Even the proposal on buyback of shares. Now, you are saying that if a company does buyback, we will shift the tax to the recipients. What if the company is doing buyback in the market? How will I know I have sold to the company or in the market? So clearly, there are certain changes which have some nuances, and this could have been handled in a better manner from a market point of view.
Nilesh, apart from the taxation part, what else in the budget stood out for you? And from a market standpoint, given that we've seen a dip, what is your recommendation now? Should one use this opportunity to buy into the market?
Sonia, I think the biggest benefit or positive of budget was fiscal consolidation. FY20 fiscal deficit was estimated at 5.8%. We are starting FY25 at 4.9%. That's 90 basis point consolidation without taking into account tax buoyancy. My feeling is that the tax collection will be higher than what is estimated in the budget, as the June quarter advanced tax collection is running at a higher level. Second, it is also committing fiscal consolidation going ahead, 4.5 for FY26, and debt to GDP ratio to remain lower thereafter. I think fiscal consolidation, fiscal prudence is the most important part of this budget.
Okay. You know, I want to make 2 points. One is this STT bit, which is going to be rolled out immediately. Will it be an issue for brokers, etc.? Because they got to calculate it, right, at a different rate, almost immediately from, I don't know.
So they will have to simply change the software.
It's nothing.
No, that's easy. It's already done probably.
Okay. And the other one is, I want to point out what ITC is doing right now. ITC is up 4.5%. Okay. And that is the single biggest sort of mover. Okay. I mean, it's not the change which has happened for ITC, it's a change which has not happened. I think it's adding about 40, 50 index points to the Nifty. And that's the reason why the market has recovered actually quite sharply. So just wanted to make that point as well.
Okay, 1 minute. There's a clarification, Mr. Kanabar and Ashok Wadhwa in particular. The higher capital gains tax kicks in from today.
So from July, sales from July.
Yeah, sales from July 23rd.
So
page 6 on the explanatory memorandum, it's a message that we've got from Ridham Desai. So he says he has seen that page, and therefore sales here on, and the previous 4 months sales will not be taxed at 12.5%, but it will be taxed at 10%. Prashant Khemka has been patiently waiting by. Thank you so much for your patience, Prashant. Well, this is also a Bihar Viksit budget, you will have to say, and an Andhra Viksit budget. And also I want to give credit to the government. You know, 11.1 lakh crore is a very good capex budget. If it has not been increased, it is because there are only 6 more months to spend that money, and there is no point increasing that. So maybe we should not be too unfair to the government. 11.1 lakh crore is a very good capex budget. But anyway, is there anything on the capital goods side that attracts you, Prashant? What exactly makes you attracts you in the market today?
No, I think other than the topic that we've discussed at length, which is the capital gains tax, which is negative, but I think overall, otherwise, it is a good budget of continuity. The prior budgets have all been very well welcomed by the market because they had all essentially the same ingredients as the budget today, except for the capital gains tax, right? So the rest of the elements, including the capital expenditure, as you pointed out, there's 6 months left, there'll be new budget. No, I don't think the particular expectations of revising upwards that number from the February budget. So that's as it is. On the consumption side, yes, the heavier emphasis on rural development and on job creation should be beneficial for consumption overall. And most particularly what I'm excited about and hopefully maybe somewhat wishful think we should make considerable progress on, and if Ashok or Dinesh have some comments on that, is the review of the tax code.
What did you want clarification on?
So the review of tax code, how it sounded like very material to me. And simplification, ease of doing business, also the fine print on gift city, because in passing, the FM did mention that tax taxes have been reduced and simplified or something to that effect, or the gifts. That would be very important to see in the fine print.
Okay. I would just respond to that very quickly. I think that it's a very important point, and sometimes you tend to miss in the light of this capital gains thing. So there was a request that the TDS rates be unified. That has been done. There was a request that TCS, one should not wait for a refund. It should be allowed to be set off against TDS. That has happened. So number of changes. So on TDS, on capital gains tax, on charity, again, I had to study all of it. So, and what she is saying is that these are the changes I'm introducing here and now, and all the other changes I'm going to review. And in 6 months, which means that the next budget is also going to be a lot about taxes.
Okay, I just want to make it clear what Dinesh has said. It's a very important point that Mr. Kanabar is making. We were all worried that if you say you bought a foreign travel ticket on a credit card, you had a TCS of 20% on it, and you had to wait for the next end of the year to claim that back. Now it will be claimed in your next salary payment itself, which is very efficient. After all, the idea was to catch those who are having foreign travels and credit card payments but not paying tax. So, this cleaning up the process is extremely important. But Kiran Mazumdar-Shaw is with us, the executive chairperson of Biocon and Biocon Biologics. Kiran, thank you immensely for sparing time. What were the first takeaways for you?
Well, everyone has touched upon all the various, financial and capital allocations and tax, slabs. But I'd like to really shift gears and really focus on a couple of areas which I thought were very positive indicators of how the government is looking at economic development. One, of course, is about the startup sector and the kind of, allocation of budgetary spending is being looked at, especially, I think the startup top sector has much to cheer about when it comes to the abolition of the angel tax. But apart from that, I'm glad to see that even at the rural level, you've got the Mudra scheme also that's looking at entrepreneurship. You're looking at a large, fillip for the startup sector in many, many ways in terms of ease of doing business. And in the case of our sector, I was heartened to at least hear an announcement that research and innovation is going to be a big focus for the government. How they've actually set aside 1 lakh crore as a budgetary allocation for private sector research, but we need to read the fine print. How is this going to be deployed? How is this going to be converted into incentivizing industry, et cetera, et cetera.
Yeah.
So overall, I think, like everyone's been saying, I think no one expected a huge change from what was announced earlier this year. I think they're trying to build momentum, and at least, everything is moving in the right direction. That's how I would put it.
Okay, point.
Right. I just want to highlight one more thing. Gold, right? I mean, gold has seen changes. So the total incidence of tax, including GST, has gone from some 18%, has gone down to about 9% or so. And look at what some of these stocks are doing.
Basic customs duty is down to 6%.
Correct. Titan is up 6%. Senco is up 10%. That entire sector. I mean, I think expectation is that this will actually spur sort of gold sales and demand, etc., in a meaningful way. So we'll have those stocks up in just a bit. But I wanted, Mr. Vadra, your thoughts on real estate, that threshold being brought down from 36 to 24 months. What will it do to for the sector? What will it mean?
Obviously, it's very good. I mean, not only 36 comes down to 24, but the rates are also aligned, which means that for long-term capital gains tax now, there's one rate, 12.5%.
Which is 12.5%.
12.5%. So you were paying long-term.
So if I sell my house now, the capital gains I'll pay will be
12.5% versus your
original of 20%.
Of 20%.
Okay, that's...
No, short-term was, long-term was 20% plus the surcharge.
Okay.
There's just one other clarification that you need to bear in mind. So when buyback happens, earlier, the company paid the tax, but the individual did not pay the tax. Now, it'll be taxed as dividend in the hands of the individual. But then the question is, what happens to the cost?
Okay.
That cost will be treated as a loss and will be allowed as a set-off against your capital gain.
That's a bit of a relief, big relief.
That's a big relief.
Yeah, absolutely. Mr. Anish Shah is with us. Mr. Shah, before I hand you over to Shireen, the last statement you made before we went into the finance minister's speech was that something should be done for skilling and employment. And there is a fairly good scheme for 1 crore youth employed, corporates get some kind of a benefit for formalizing those jobs. What's your first reaction?
So first reaction is very positive. We see this as a growth-oriented budget that meets various different factors that we would want from an industry perspective.
Right, Anish, let's get down to some of the specifics. And we didn't hear it in the finance minister's speech, and I don't know whether this is going to be part of that green transition plan and roadmap that the government says is work in progress and will be announced. But no FAME 3 in the speech so far. We still have to go over the budget documents to see if there is an allocation there. Anish, what do you make of that?
So Shireen, we were not expecting FAME 3 in the budget itself. All indications that we had received was that that would be done separately as part of the normal course from the various ministries. So this is not something that we were expecting in the budget.
Okay, so you weren't expecting FAME 3 in the budget, but on balance, in terms of what the government has done, continuity on the big numbers, in fact, pretty much staying intact with the interim budget projections, as well as some of the changes brought in, relief for the salaried class, some of the tax changes on the simplification side, and of course on capital gains, the changes that have already been discussed in detail by our tax experts. But on balance, what would be your biggest takeaway from what this budget has managed to achieve?
On balance, Shireen, it's staying the course. It is a growth-oriented budget that focuses on inclusive growth. There is a strong element of simplification and ease of doing business. And if I were to look at it from a FICCI perspective, it really meets all the priorities that FICCI and the industry had laid out, which is around Make in India, women-led development, farm prosperity, and sustainability.
Specifically on the manufacturing side, and I want to link this to the job creation schemes that have been highlighted by the government, and link this also to what they have decided to do to nurture and bolster MSMEs. What, from an overall holistic manufacturing perspective, Anish, how much does this change things? How much does the compass move on account of the many measures announced by the budget on jobs, on industrial parks, on supporting MSMEs, on access to credit?
Shireen, it's a significant step forward in terms of developing India as a manufacturing hub. The focus on infrastructure, the focus on capex continuing to be at 3.4% of GDP. The focus on jobs, because that's going to be, skilling is going to be an important aspect for India to become the manufacturing hub. And that combined with the short-term stimulus on demand through tax break for salaried, which is to the tune of 17,500 rupees. I think all of those things are positive from a manufacturing standpoint and are the right steps to be able to really make India the manufacturing hub for the world.
Nilesh, let me come back to you now. While we go over the fine print, again, in terms of some of the policy announcements, for instance, PM Awas, etc., also the allocation not being announced, saying that we will put that number down. Many other such work in progress, including the income tax simplification. That was, of course, a big positive that has been spoken of. Nilesh, to your mind, outside of the tax-related changes, the 3 or 4 big-ticket items that you take away from this?
So one, the fiscal consolidation, that's really big and positive. Second, import duty cut on gold. Today, gold returns are included with 18% tax incidence. Tomorrow, that will be included with 6% or 9% tax incidence. And that will take away some return of gold and hopefully allocation to gold. The third thing, which is very good, is related to new pension scheme. The employees' contribution has been upped from 10% to 14%. I hope and pray every employee takes advantage of NPS. Not only they secure their future, but it also cultivates long-term investment habit. And one more thing from a market point of view is safe harbor clause review. Today, so many of Indians are managing money into India from outside jurisdiction of India. We don't benefit in any way. and we allow other countries like Singapore and Dubai to develop as a regional financial center. The finance minister, in our pre-budget consultation, we had requested Honorable Finance Minister to look at safe harbor clause. And I'm very glad that it has been announced in the budget. Hopefully next time Prashant Khimka will be in studio and not giving from outside of India.
Okay, good point, Nilesh. You know, there is a doubt about whether indexation has been removed for property. Would that be at all done?
I mean,
I think it's an error.
So
if they brought the tax rate down to 12.5%, I wouldn't be surprised.
They would remove indexation altogether?
Altogether. So there are two changes.
Okay.
One is that there was an arbitrage on interest. So if you had debentures
You mean a
or
house you
bonds,
bought for like maybe, 30 lakhs or something back in the 90s or back in the 80s would now be worth several crores. You mean the 12% will apply on that level?
So two changes. The first is that if you have any interest yielding asset, debentures or bonds, what you could do up to now is that you have interest maybe back-ended, sell it and make capital gains.
Yes.
To remove that, they have now said that bonds and debentures, if you sell, the income will be short-term capital gain, even if you held it for a period
Fair
of more
enough.
than 2.
No, I'm more worried about the property bit.
Yeah. So it's not just property. On all asset classes, indexation seems to have been removed for sales after July.
Okay, now that's a big one. We'll have to ask realty companies and even individuals. I think whatever you got, the paltry gain you make in terms of capital gains limit being raised from 1 lakh to 1,25,000 is more than wiped out.
Or the rate coming down.
Or the rate coming down gets wiped out with this.
Yeah.
But Nilesh made a very important point about the macros and that 4.9% fiscal deficit. It's very good to see that 4 handle on the deficit after a very long time, after maybe 4 or 5 years. Does that put us in line for an upgrade, Nilesh? I mean, is this a very big step towards a very long journey, of course?
So Lata, I will start with a lighter vein and then let Sajid answer it in a serious way.
Okay.
Well, the rating agencies are saying that we are Moody's and we have poor standards. To expect from them a rating upgrade will be a bit difficult with these numbers in a track record of not defaulting since Mohenjo-daro days.
Okay.
I'm sure rating agencies will require long-term track record to upgrade India's credit rating.
No,
5,000 years is not good enough.
No, Nikhil, Nilesh, see, we have to live with what we have. So there's no point, trying to compare people. So we also have to remember that compared to all other BBB minus countries, we have a higher fiscal deficit and a much higher fiscal deficit. But that's a different debate for a different day with a different audience. Sajid Chinoy has joined us. Sajid, all the big numbers are with you. What would your take be? Fiscal deficit down.
I would say macroeconomically very prudent, very sound, right? So the deficit, as you said, the center is below 5 at 4.9. Importantly, center and states combined in FY25 should be below 8% for the first time in 5 years. Now that's meaningful. Number 2, this is a good balance between saving and spending. Compared to the interim budget, the government had about 0.5% of GDP in extra resources, both taxes and the RBI dividend. And that's been split very well. It's a half of that has gone towards more consolidation and lower deficit, and half of that has gone towards revenue expenditure, which I think was needed. Number 3, the assumptions and taxes, very conservative. Last year, on a nominal GDP of 9.6, gross taxes grew 13.5%. This year, nominal GDP is pegged at 10.5, which is fair enough. And on that, we're just assuming gross tax growth of 10.6%. So it's 10.8%. So it's just barely over 1. Now, to be fair, there are many tax changes, so we need to account for how much that adds or subtracts. But prima facie, the assumptions and taxes are extremely conservative and could surprise to the upside. And the last thing I'll say is, there's a lot of focus on what's happening in financial markets. I think we should step back and look at the important things this budget has done on plumbing. Me in particular, focusing on employment, focusing on skilling, focusing on cutting import duties so exports become more important, focusing on reforming direct taxes so that we've got more space for higher expenditure. These are the plumbing issues that I think we'll grow to appreciate over time.
I completely take your point on employment. If this really fires, if corporate India is able to take advantage of the SOPs given so that you hire newer employees, and those SOPs are available for the next 4 years for 1 crore employees, then we've definitely inched up on formalization of employment and employment per se. So full credit to the government for those. And the benefits of that are only going to be reaped in the years to come. Employment, I mean, an employer cannot start employing more new people simply because 4,000 rupees is available per new employee. But nevertheless, it is one small step, and it will perhaps help mid-cap companies. Mr. Anisha, you've perhaps gone through the budget and thought over it in greater detail. Do you think this moves the needle on employment?
I think it's a good step because it starts signaling that we should be looking at growth with jobs, with skilling. And even if you were to take it as here's an amount that's given for skilling new folks coming in and making it easier for companies to employ faster, I think that's a positive step. So therefore, it's not going to change a decision to employ based on what was mentioned earlier, especially for larger companies, because that's going to be based on growth, on capex, etc. But I think this does make it easier and pave the road for us to be able to start looking at jobs and skilling in a much bigger way.
Okay, fair point. Once again, I would say that we wouldn't fault the government for not increasing the capex budget, because you have only 6 months left, and increasing money and the capex budget was not met. Capex expenditure was not met in the April-May numbers, which we already have, for the simple reason that the government was busy. Several bills would not have been passed by the departments concerned. And therefore, not increasing the budget this year is okay, but 1.5 lakh crore has been given as interest-free grant, 50-year interest-free loans to the states, and therefore that kind of capex can continue. Shireen, you have some questions?
Oh, well, that's right. We do have our panel here, the top brass of CII with us, Sanjeev Puri, CB, many thanks for joining us. ITC, the stock of the moment, the last time I checked, it was up by about 4%. So that should certainly be good news for you, Mr. Puri. But let's talk about the budget on balance now. Many of the things that we talked about in terms of continuity, in terms of stability, especially macroeconomic stability, the budget has clearly and squarely delivered on that. Some of the ideas, and a lot of this will boil down to finally execution as well. But on the job creation front, because again, the compact with industry is what the government is hoping for. Do you believe that this will incentivize industry to hire more? Or do you believe that, look, there has to be a business case for industry to hire? The incentives may not move the needle much.
Okay, let me first start by saying it's quite a commendable budget, because it's really looked at the issues of jobs, as you've spoken about. It's looked at in depth about rural and agriculture, issues of climate change. At the same time, very important focus on, the journey for the next phase of transformation, next generation reforms, a lot of work on ease of doing business, and a lot of, coordination with state and incentivization with state, looking at a lot of important issues of natural resources like water, land, and all of that. So extremely, extremely good. Now coming to this specific question on livelihood. Now, of course, there has to be no doubt a business case, but what is required is that the economic transformation continues, which is what the policy continuity and additional interventions will do, and all these incentives reduce one element of the factor cost. So it does kind of add some impetus to the whole employment situation. But more importantly, I think what is going to lead to more livelihood creation is also the very strong focus on skilling.
Yeah.
And this whole ideas of top 500 companies, apprenticeships, and a lot of other schemes are there within education and skilling. I think those are very important, because today we are also sitting on opportunities which are not filled in a timely fashion because there's a mismatch in skills. So I think that itself on its own will lead to job creation.
So your biggest idea or your biggest takeaway from the budget?
I think it's very comprehensive, and it addresses this whole area of economic transformation for livelihood and for fighting climate emergency quite well within macro stability.
And we need to see the roadmap as far as the green transition is concerned. Welcome to Mr. Mukundan as well, and Rajiv Memani, you're back. You stuck your neck out and said you believe this will be the budget that will move on capital gains, and that's what's happened. The expectation was that they wouldn't do both short-term as well as long-term. Both have happened. Go over the fine print for us, and what to your mind will be the implications and any clarifications that you believe are needed.
Yeah.
I haven't gone through the fine print as yet, but I can, from whatever I've made out from the budget speech and a few paras here and there, I would say that you can break the tax thing into four sort of buckets. One, I think, is there has been a focus on simplification. So whether it's announcing that they will come out with a new tax code by next year,
next 6 months,
Vivad se Vishwas, and then on TDS, providing TDS credit and everything else. The reassessment thing is a big thing. So I think there are many things. The second, obviously, is capital gains, which on long-term capital gains, the rate's gone from 10 to 12.5%, on listed equity, 15 to 20%. At the same time, for land, it's come from 20% down to 12.5%, although indexation has been done away with.
So that's the clarification that we were hoping for. And Prashant, Lata Surabhi, Rajiv Memani confirming that the indexation for real estate has been done away with, even though the tax has been reduced to 12.5%, the indexation benefit has been done away with. Go ahead, Rajiv.
And buyback tax, which has been changed. But the way they have said is it will not be treated as capital gains in the hands. Earlier, company was paying buyback tax. It will be treated as dividend income, and the cost that they have, that will be treated as an expense against that. So I think that's a logical way of doing that. So I think that on the capital gain side, debt-oriented mutual funds will be happier. So on the capital gain side, and on REIT and InvITs, there was an anomaly. So that REIT and InvITs now becomes in the same way as listed equity shares. So I think REIT and earlier the capital gain tenure was 3 years. Now that comes to 1 year, and the rate also changes. So I think overall, I think the second level of change would be in the capital gain area of capital gains. The third, foreign companies, I think equalization levy of 2% going away. It came in 2020, not as part of budget, but it was later on added. And secondly, foreign company taxation
being reduced
by 5%. So I think that was a big ask from a lot of people. So I think that will benefit a lot of the foreign companies who have branch setups here or who've got project offices here. And I would say fourthly, on the personal tax side, as we had discussed, I think the pivot towards the new tax regime is there. So standard deduction benefit only available to in the new tax regime. There's some changes in slab rates that have happened. I think that's also
only in the new tax regime. That's right.
And NPS also, if I'm not 100% sure, but I think that also is probably only in new tax regime. I'm not 100% sure.
Well, on the NPS, she said we're working on the solution and we will arrive at that.
No, she said 10. So what was earlier available to government employees, they could get 14%, and private sector employees were getting 10%. Now both of them go to 14%. So that gets balanced out. So I would say the tax things I would break into sort of as it on direct tax. If I was to look at it, I would break into 4 buckets. I think a number of tax changes, honestly, after a long time in a budget, you've seen.
It's been a heavy budget for tax.
I think some, especially on the simplification side, the reassessment piece and everything, there will be. And the big thing, Shireen, I think, as mentioned, I think the government sticking to the macroeconomic stability. And the focus on jobs and skilling, I think that's really massive, really bold moves on that, big change on that. So I think government clearly recognizing that this is a big area to solve.
Yes, it is a big area, it's a big challenge, but Mr. Mukundan, as far as growth is concerned,